The problem with most financial shows when it comes to calling the market is that it's one guy's opinion over and over again.
Sell, sell, sell!
But any veteran investor knows that there are two sides to every trade, a buyer for every seller, and vice versa.
Buy, buy, buy!
That's why MoneyLife brings you a wide range of experts.
I need people who, can work well under pressure.
Each day you get the benefit of a new set of eyes on the market with different methods and decision-making tools. Every day you'll hear a different expert giving their take on the market, on what looks good, what looks bad, and how they feel about some of your stock selections.
This stock is blowing up right now.
You never know who might show up to talk stocks. It may be a famous money manager or someone you've never heard of before.
No!
But you'll always get their straight talk.
Must you always be so blasted honest?
Their straight talk, that is, about what they see happening on the market and where to think about putting your money on the daily MoneyLife Market Call.
That's right. And today in the MoneyLife Market Call, we're going to wrap up the week with one of your favorites. His name is Brent Wilsey. He's the president of Wilsey Asset Management. And when I say, hey, who do you want us to have on the show, etc., well, he elicits a lot of response because he gets through a number of stocks, but also he's got a very distinctive style that I think is appealing because it's numbers driven. It's the kind of thing that if you listen to what he does and you say, wait, these are the things that appeal to him, you can actually easily apply this to whatever it is that you are looking at for your own portfolio. So you can sort of have your own check and balance here. If you want to find out more about Brent and the firm, you want to get a link to his radio show, any of those other sorts of things, it's WilseyAssetManagement.com. And Brent is on Twitter. He's at Brent Wilsey, but right now he's here. Brent Wilsey, welcome back to Money Life.
Chuck, great to be here.
Always good to have you on the show. Now, I mentioned a numbers, sort of very standard driven process. Explain what it is that you look for and how it works.
Sure. What we do is I'm looking at the financial statements of companies. And the way we do that, there's a lot of ratios that I learned in accounting and so forth and how to actually buy a business. Well, I look at what we pay for the earnings, the book value, the sales, the cash flow of a company. I don't like to pay above the industry average because I'm looking for good buys at good prices. I will look at how the sales are going, how the earnings are going to make sure they are growing their sales and earnings. Very important, Chuck. I don't want to buy risky companies that could go broke tomorrow. So I very simply look at the balance sheet. Do they have enough liquidity? Is their debt level too high? To make sure you're not buying a company today that could be broke 6 months from now and file bankruptcy and you lose all your money. We do look at how they do on the equity portion. They get a return on their equity. Is there profit margin? Do they have a profit margin? And also how efficient. I look at their receivable turnover and the inventory turnover. Then we'll look at the earnings going forward, and I take the mean estimate of the analysts and go out as far as they can. Right now, we're going to about December 2016. And very important, Chuck, I want to let you know a change I've noticed recently. We use GAAP numbers, which is general accepted accounting principles. Well, I've noticed on the earnings estimates going forward, a lot more companies are coming out with their own pro forma numbers and using those numbers. Now, they have to disclose GAAP, but some of these estimates people are finding out there on the internet are the pro forma numbers, not GAAP numbers.
Yeah, pro forma is Greek for, this kind of seems right.
Well, it's what they actually take. They'll say, well, don't worry about the stock-based compensation we're paying our employees. Don't worry about the mistake we made. We had to restructure. Don't worry about that thing that we bought. We had to amortize it, and now we got to write that off. Don't worry about that stuff. Just look at what we're telling you to look at. So GAAP is there for a reason. You should be using GAAP accounting, not the pro forma accounting.
Absolutely. All right. So let's talk, as you talk about that, what you didn't mention anywhere is things like the economy and the market. So I've got to ask, how much for you is relative when you look at the numbers? We have guys on the show who will say, I'm a value manager, and they say, I always find value, or they'll say, I'll find relative values, etc. Because you're looking at the numbers, if the ratios don't work, I would assume they don't work for you at any point. But are there times where you say, okay, to find something worth buying, I have to change my standards? Or are your standards market agnostic?
Never change your standards because of the fact that if you change your standards, you no longer have a discipline. And I've seen people where they do great and then they don't so great because they change things. And it's funny, I talked to my son who is now in the business and so forth. We're discussing being patient when it comes to investing. You can't be invested all the time. You've got to look for those good buys. And right now, the market where it's at, it is harder to find good buys. And I like to buy a company based on forward earnings around 10 to 12 times earnings. Much, much harder to do now in 2015 than it was back in 2010.
Does that mean that when you buy something and you've got the right numbers to make you say, I'm going to buy it, at that point, how much do you then reevaluate? It's sort of one of those things. I mean, I'll for my audience, I'll try to define this question or describe this question simply. Think of it like a dividend, where if you're getting a certain yield because the stock is cheaply priced, when the price goes up, it changes your yield, but your yield is still basically what you were getting paid when you bought it, because, you know, that's the return on the money you first invested. So for you, when we talk about those numbers having to stay, changing the numbers becomes something that makes you sell it. If if forward earnings change dramatically, but the company's going well, are you out because you need to be out?
No, I mean, what would happen, and we did this, about a year or two ago, and it does happen, where you buy something based on these numbers, and then 6 months down the road, what I call it, the fundamentals break down. If the fundamentals break down, and say the forward earnings went from 12 times earnings up to 18 times earnings, I'm going to sell. Now, maybe it's at a loss, but that's not the same company that we bought before. And it's funny, this one I'm mentioning now, my assistant Tara just looked at it today for some reason. We're looking at some of these companies that you gave us. I think that was one of them. But we bought the stock at 21. Fundamentals fell apart. We sold it at 17. That is now at $4 a share. So you've got to stick to those numbers because they will be right perhaps on the longer term. But if you're not looking at those numbers, sooner or later, you're going to be burnt. And I've seen people go 6, 12, 24 months, everything's fine, and then the bottom falls out, and they lose all, big portion of their money because they stay at the party too long.
So let's talk about something that right now passes your screens and is the kind of thing where you look at it and go, yeah, this is what I'm telling my clients I can buy right now.
Well, I'll tell you what we're looking at, and I'm not completely done with it, but I want people to kind of start looking at it because it's in this area. It's called Freeport-McMoRan. Their symbol is FCX, and I've kind of got some interest because this stock has fallen way down. Right now, the stock trades around, $19 a share. I remember the stock was like $100 a share, so now I'm starting to get excited about this, and I'm going to kind of share with you what I like. Now, there's no earnings the past 12 months because they've had some difficulties, but you're only paying about 1 times the price to book, which is about 1/3 of the industry, so that's a good value play. Their sales have gone up 2.5%, but their earnings fell 148% year over year. So I want to know what's going on there. I haven't done that research yet, so I'm kind of sharing with you my early research here. The balance sheet is worrying me a little bit. Their debt's 103%, which is on the high side. So what I'm going to look at is, are they paying down that debt, or is that debt increasing? If that debt's increasing, I'm out. I'm not going to touch the company. The return on equity is also negative. The liquidity was a little bit, could be better, but it wasn't bad. And then I looked at their inventory turnover. It was better than the industry. It's 3.7 versus 2.9. So I think the business is going okay. Now, when I looked at forward for the analysts, there's 16 of them. The mean estimate of those 16 analysts for December 2016 is $2.33. I put a multiple of 16.5 on that, which is the 40-year average of the Ford PE. I get a target price of $38.45, well above the $19.18 for a gain of about 100.4% is what the gain was. So I'm interested in this company. I'm not going to put it on portfolio yet, but I'm starting to get excited about it. I'm going to be patient with it and do some more research, but I want to share with you what I'm looking at to start here.
Well, we definitely have had a number of people talking about FCX, Freeport-McMoRan, on the show. You are far and away the most optimistic of those folks. Let's come up with something else. What's something that maybe has now gotten to where it's ready to buy?
Well, and right now in our portfolio, we do hold a company called Parker Drilling. And I want people, the energy sector is a good place to go, but you got to be careful. I do a radio show here in San Diego. Somebody called in Marathon Oil. Should be good. I looked at it. It was fully priced already. But what you have to look at, Chuck, besides the earnings, is a lot of energy companies that are good companies are trading below book value. And right now for Parker Drilling, for the tangible assets of this company, which are like their buildings, their cash, their rigs, and so forth, you're paying 61 cents on the dollar. I mean, that just tells you this company's on sale. They're very liquid. They got a current ratio of 2.6, which tells me they can almost pay off their current liabilities over the next 12 months almost 3 times. So the company's not going to be going under because they can't afford to pay their bills. They just reported earnings for December not too long ago. The estimate was 4 cents. They actually made 6 cents. They have a trailing 12-month PE of 17.5, which means they've earned money over the last 12 months. And yes, they're being hurt by the decline in oil prices, but it's a strong company. They're going to turn things around. And I can't tell you when oil's going to turn around, but I can tell you if I can get a solid company for 61 cents on the dollar for the tangible assets, I want to buy and own that company.
And so that's Parker Drilling, PKD. Now we're going to find out how you feel about some stocks that my audience is particularly interested in.
Play hold it.
You got to know when to hold up.
Or fold it.
Know when to fold up.
It's Hold It or Fold It with my guest, Brent Wilsey, president of Wilsey Asset Management. If you want more information on the firm, if you want to check out his radio show, there's links to it at his firm's site. That's WilseyAssetManagement.com. He's on Twitter at Brent Wilsey. Hold it or fold it. You know how it works. If you want to participate yourself, send your name, your hometown, and the ticker symbols you're interested in to Chuck at MoneyLifeShow.com. We're going to start with a request that we actually talked about on yesterday's show, but I sent the list out to yesterday's guest and today's guest at the same time. They both want to talk about this stock. Jill in Port St. Lucie wants to know about Under Amor Corporation. It's UA.
Chuck, this is a great company. I love their products. I wear them to the gym and work out. I know a lot of kids are wearing them now, but it's different when you actually look at the fundamentals of this company. I looked at them, I was shocked. I mean, you're paying for the past 12 months 87 times earnings, 63 times cash flow. Now, the company has grown their sales by 33% year over year, earnings up 25%, and this is going to suck in those momentum investors because, wow, look how great their sales and earnings are doing. They do have a good balance sheet. They return about 17% of their equity. But what I looked at, too, was the analyst estimates, and there's 28 analysts, and they say the year ending December 2016, looking for earnings of $1.42 up from $1.09. Sounds pretty good. But if you put a multiple on that, you'll see that you're paying 57 times forward earnings for this company. And that's just high. It's extremely high. I'm kind of speechless on that. Our target sell price is conservative at 16.5, would be $23 a share. Now, Under Amor may go to 90 or 100, but I'm telling people, be careful. You're in a car doing 100 miles an hour right now, and if you hit a pothole there, you're going to crash and burn. This stock is very expensive. I would not touch this with a 10-foot pole. The company has to make a profit, and you got to not overpay for that profit.
This whole thing is insane.
Yeah, and remember, Brent said it could be a car wreck waiting to happen. That was a sell on Under Amor UA, and for the second day in a row, I will remind the audience that it is the single largest holding in my daughter's portfolio. She's going to have some decision-making to do on this one. Jim in San Francisco wants to know about CIGNA Corp. It's CI.
Here's a company that I liked it, and they're in the healthcare field, a good field to be in, but they're getting a little bit expensive. Their PE is around 16.5 versus 12 for the industry. Their price to book value, which I talked about earlier, 7 versus 1.5. They are growing their sales. Their earnings up 48%. Return on equity is 19.7. But when I look at the earnings going forward, they're going to jump from around 821 December 2015 to 914 December 2016. So stock around 130 right now. Our target sell price would be 150. I don't think it's worth buying this company. But gosh, if you hold it, I think I'll hold on for a little bit longer and see if I can't get the full target price of $150 a share.
No money changes hands today.
Hold it if you got it, but don't buy more on CIGNA, CI. Pack in White Plains, New York wants to know about GameStop. It's GME.
You know, Chuck, this is one that is kind of amazing to me because I always worry about, are the games going to go away? Well, GameStop seems to keep just proving that to me, and it looks like a great buy. I mean, you're paying 13 times earnings for it. They're paying a 3.5% dividend. Only use 40% of the earnings to pay that dividend out. I did see sales were up 6.6%, but earnings, well, they were down about 3.5%. The balance sheet, you only have a debt to equity of 17.6%. They make about a 4% profit, which is above the industry, and the receivable turnover just doing phenomenal, 92 times over the last 12 months. Looking at the earnings, they're expected to increase to January 2015, 342. Then it goes to $4.04 in January 2016. So the analysts, 11 of them, are seeing sales increasing. Well, gosh, that gives me a target sell price in this company of $66 a share for about a 63% gain, and you get that 3.5% dividend. So the numbers look great in this company, and they must be doing something right, and we're not going to see the loss of games anytime soon.
Would you mind stepping aside? I've got a purchase to make.
That's a buy on GameStop, GME. Charles in Clearwater, Florida wants to know about American Capital Mortgage Investment Corporation, MTGE.
Well, here's a company I want to point out before I get into the numbers. You got to be careful because I think this company could be hurt dramatically if rates go up quickly because it is a mortgage company. With that said, the numbers look very good. The price to tangible book value, 0.8, that's very good. Their sales are down 28%, but yet earnings up 289%. If I was going to buy this company, I want to know why that changes there because it does concern me seeing those numbers. No debt on the balance sheet. I see the profit margin. Another thing worries me, 86%. So I'm starting to wonder when I look at these numbers, is it possible they sold some assets or something that they increased their net profit, but we won't see that next year. So be careful. The analysts do like it. They said the year ending December 2016, looking for earnings of $1.94, and the estimates are pretty tight, only about 15% difference from the high to the low. Our target sell price here would be $32 for a gain about 74%, and the PEG ratio also backs it up at 1.2.
Winner, winner, chicken dinner.
Yeah, that's a buy on American Capital Mortgage Investment, MTGE. Last, John in Seattle wants to know about United Parcel Service, UPS.
This is one I liked before. I remember when they had $60 a share. People were worried about them. Well, now this stock is near $100 a share, and it shows that in the numbers because you're paying 30 times earnings for this company right now, 18 times cash flow. Their earnings declined by 29%. What really scared me, Chuck, was their debt to equity, 500%. That's 5 times their equity. I mean, I just don't get that. I didn't look at the balance sheet, but that's just amazing at what their debt level is. And then also, too, they have a profit margin of 5.7%, but be careful because rising gas prices could hurt them and slow down sales. Looking forward, the mean of 19 analysts looking for $5.87 in earnings. That gives me a target sell price around $97. So it's above the target sell price. If you own this, I'd say sell, get out, don't buy it.
So that was a sell on UPS, ticker symbol UPS.
It's topped out. I say we sell now.
And unfortunately, we've run out of time, so we've topped out as well. So we have to say goodbye to Brent Wilsey. But the good news is I know he will come back again soon. Brent, it's always great to chat with you. Thanks so much for taking time out to join us.
Chuck, thanks for having me.
Brent Wilsey is the president of Wilsey Asset Management. If you want more information, WilseyAssetManagement.com, on Twitter at Brent Wilsey. All right, folks, we're going to finish up this week and get you set up for next. Just stick with us a little bit longer. We'll cross the finish line next when Money Life continues.